All right, everybody, welcome to the Senior Solutions Friday Agency webinar. My name is Joe Johnson. I'm with my co-host, Michael Mahalik. Michael, you want to say hi to everybody?
Hi, Senior Solutions Nation. Hope everybody has a good Easter. We're looking forward to meeting everybody face to face across the country here in the next couple of months. So welcome to the call.
Awesome, guys. This is a live webinar that we're doing. Obviously, we're recording this. We're going to get it out on our YouTube channel. We're probably going to get this posted on our website today. I think this is a very, very important subject. I'm going to go in depth on a lot of things and kind of do a side-by-side comparison between the Mutual of Omaha Term Life Express, specifically with the ROP, and the IUL Express, which is Mutual of Omaha's simplified issue IUL product, which they came out a couple years ago, which I have to say, other than Final Expense, probably my favorite product that they have ever since they came out with it. I just think it's a great product, easy to sell. And I'm gonna kind of go over the reasons today. What's the differences? Because there's a lot of similarities, and maybe which is better. Which one should you be selling to your client? So with that, let's go ahead and get started. First thing I'm going to cover is the application, and then let me just get a highlighter. I always like the red color. Give me 1 second. All right, now I can see this better. First thing I want you to understand is when it comes to underwriting and the application, even though they're different chassis, one's a term product, one's an IUL, you use the exact same application. So if you're writing a paper application, as an example, it is the exact same application as the Term Life Express. The only difference is there's an extra page there for allocation, and I'm going to go over a little bit of differences. But if you're writing up a Term Life Express, and we're only going to really be talking about the ROP, this is where it says term. The ROP, first of all, is only available on a 30-year term. So you have to select the 30-year guarantee, and then over here you would just simply mark that yes, you're doing it with the ROP, and then you put in the face amount. Okay. If it is and then there's the eligible riders. Here's all the riders that are available on the term product. One thing you got to keep in mind and understand, and don't shoot yourself in the foot, because I've done it before, is that if you're selling the Term Life Express and you're pitching on the ROP, don't pitch the disability income, because it's not available on ROP. Disability income rider is only available on non-ROP products. So if your client is really pushing you and asking you about like disability income, don't oversell the ROP. Keep it simple. Sell the regular term, like if you're selling mortgage protection, sell the mortgage protection term with the disability rider. Don't get in the weeds about the ROP. Okay, I personally made that mistake a long time ago, but once you do it once and you lose a sale, you won't do it again. So here's the riders for permanent. Now it looks like this is an older application, because I know this GULE, that product is not even available anymore, so we'll just put a line through it. But when you look at the new application for permanent life insurance, you're going to select the Index Universal Life, the face amount, and then you're either going to select it doing the easy solve, or if you're doing something like a full illustration where you're showing the client and they elect that they want to overfund it to be able to get that cash accumulation for maybe use it for retirement, or maybe they want cash to be able to pay their house off early, or be able to make tax-free withdrawals later, then you would want to select without easy solve. If you select the easy solve, which is basically kind of like close to target premium, easy solve is a way to sell an IUL. It's very simple, and EasySolve is really designed that they're not overfunding it to accumulate a lot of cash value, but they're accumulating enough cash value that should keep this policy in force minimum to age 100, if not past, so it does not lapse. Without EasySolve is when you're specifying a specific premium amount because you're allocating more money towards the cash value. Again, if you do the EasySolve, you do not have to submit the IUL allocation form, which is because there's only one credit strategy for EasySolve. Okay. If you select without EasySolve, in other words, you would have to go into WinFlex in order to do that. Then you do need to submit the allocation form. Now, here's one thing I'm going to tell you that is a lot of agents don't understand. Regardless, if you're submitting an IULE at EasySolve or without EasySolve, you still have to submit a signed illustration. Okay. If you do, like, let's say, for example, you're in the home and you close them and you either do an e-application or a paper application, you can submit the application, but at some point you need to get that illustration signed. If you don't, Mutual of Omaha is going to go ahead and issue the policy, okay, but they're not going to pay you a commission. They're going to mail out the policy with an illustration to the client for them to sign it. And then when the client mails it back, then they'll pay you your commission. Okay. A lot of agents had to learn that the hard way. So just keep that in mind. Even with EasySolve, regardless, anytime you sell the IUL Express, make sure that you are either prepared to go back that day, or maybe the client, if you're doing an e-application and you have WinFlex, I mean, if the client has a printer at their home, a lot of times what you can do is you can just email them the PDF. They can print it right there at their house. Or maybe you find a Kinko's or Staples or Office Depot or somewhere, and you can email them that, go get it printed, go back. I like going back that same day, getting it signed, and then submitting it all together. Okay, and then as far as the writers that are available, here are the writers that are available. I'm not going to get into the weeds about all these. This is not in-depth training on each specific product. This is training on how they compare to one another, the kind of the pros and cons. The underwriting is exactly the same. So all the health questions on the IULE and the TLE are exactly the same. There's no differences. In fact, if your client decides to do Term Life Express and you submit an application, but they change their mind and say, oh, you know what, I changed my mind, I really want the IUL, you don't need to resubmit an application. They can flip it. Okay. So again, they are the exact same application. All right. Now I'm going to get into some of the highlights of, I'm just going over the highlight product, which, by the way, all this information that you're getting, you can go to the mutualofomaha.com/simple, and all this information is right at your fingertips. But this is the highlight sheet. Okay. With the Term Life Express, they offer terms of 10, 15, 20, and 30. The return of premium, however, is only available on the 30-year term. The other thing you have to be careful of is the age. Term Life Express recently, a couple years ago, they expanded the issue ages to 70, which I think is great, but they left the ROP at age 50. So if your client if they've had their 51st birthday, they're not eligible. Now they can be 50 and 364 days old. They haven't turned 51 yet, they're eligible. Once they hit 51, not eligible for the return of premium. Here are the face amounts. So if your client is under the age of 50, you can go as low as $25,000, which I love, as high as $300,000, and it's all simplified issue. All they're going to do is run an MIB, prescription history. Depending on their age, they're going to run a motor vehicle, make sure they don't have DUIs or reckless driving. Risk class is the same. There's only 2 risk class. They're either tobacco or non-tobacco. Return of premium is available. With the ROP, they only get 100% of the money back if they keep it for the full 30 years. Okay. If they're only into it for 10 years, as an example, they're only going to get a portion of the money back, maybe 20, 30%. I believe they need to be into it at least 12 to 15 years to be able to get about half their money back. That's one of the negative parts about ROP. If they, for some reason, they can't afford it, they're kind of stuck at that premium amount. They can't. It doesn't have flexible premiums. What's included? Well, the benefits are, they do have the accelerated death benefit, living benefits. Now, this is an old flyer, which Mutual of Omaha has not updated on their website yet. Living benefits. Here it says non-ROP. They just changed that. With ROP, they now are eligible for all the living benefits, which is huge. You got chronic illness, terminal illness, and critical illness. Understand those benefits because that's a huge selling point, having those living benefits. On the Term Life Express, you have the residential damage rider, which is not available on the IUL. Then they also have the waiver of premium for unemployment, which is meant for this is kind of selling on the mortgage protection side. And just be careful on the unemployment. They have to be in the policy for 2 years in order to have that qualification. And they have to be eligible for unemployment. So if you have someone who's self-employed, they own their own business, not going to qualify. If they get fired and they get turned down for unemployment, not going to qualify. But if they do qualify, if they've been in the policy for at least 2 years, this is kind of a nice selling point, and they get laid off, Mutual of Omaha will actually not waive, but actually, well, I guess you can say waive. Yeah, they'll waive their premium payments for up to 6 months. Okay, so that's kind of a huge deal. Common carrier disability income, remember, not available if you're doing the ROP. Disability waiver of premium, that's available. Accidental death benefit doubles. The policy is renewable to age 100. That's kind of a selling point if you're selling this coverage. Although that doesn't really apply to the ROP, because the whole idea of the ROP is that at the end of 30 years, you're taking all the cash back. So you wouldn't be renewing it. Okay, that's all the highlights I want to cover for ROP. The highlights for the Index Universal Life are very similar. Same issue ages. You can go all the way down to age 18, all the way to age 70 as an issue age. One of the little niches that I have found, Michael, on the IUL Express is when you have those clients, what we would normally kind of consider in the age bracket final expense clients, they're in their late 50s or 60s, but they're in really good health. They've never had a heart attack, stroke, cancer. Maybe they got high blood pressure, that sort of thing. They can even have diabetes as long as that diabetes was diagnosed after age 50, and they can be insulin dependent diabetics as long as there's no complications. As long as that diagnosis was after the age 50, we can still get them approved for an IUL Express. What's nice about this is that if you have those clients that are in, like I said, mid to upper 50s, 60s, even all the way to age 70, but they have the financial capacity where, they're looking for a final expense product, 25, 30, 40, maybe even 50,000, and they're healthy enough. Why not present the IUL Express? They're going to be able to get a lot more coverage for the same premium as they would as a final expense product. This IUL Express is written at a table 4, final expense is written at a table 6. But if your client has never had a heart attack, stroke, cancer, or any major illness, they're falling into that table 4 category. So why not get them a better product as long as they have the financial capacity? One thing you don't want to do is, sell somebody on the idea of an IUL Express and they're older. Number one, they don't qualify because they had a heart attack 10 years ago and you forgot to ask, or they just don't have the financial capacity. So it's kind of good. Normally when I do the switch is that after I show them, I do my 3-option close, Michael, and I show them the maximum benefit of $35,000, and they're kind of leaning towards that, and they feel like they can afford that premium of $100, $150 a month, and I know they're in good health. Then I will kind of lean back and then show them how we can get them into potentially a better product for a lower premium. Okay, so highlight sheet. So I like the fact that the face amounts are the same as the Term Life Express. The benefit of this is that with that Term Life Express is that the issue ages with the ROP, it cuts off at age 50. Here, if you've got a client in their mid-50s, you can show them a product that's going to, in my opinion, outperform a return of premium where they wouldn't even be eligible before. There's you can do level death benefit, you can do increasing death benefit. All the living benefits are available on this, so I just want to talk about that. They have the terminal illness, chronic illness, and critical illness are all part of this policy. They also have a guaranteed no lapse protection for 20 years. That would be more if you're doing if you have someone that wants a permanent policy, but they're kind of on a tight budget and you just want to show them the minimum premium. It has a 20-year built-in no lapse guarantee. Which then they can put more money in later. Some of the optional riders that they can get are the accidental, let me move my screen here. Accidental death benefit, disability waiver of premium. That's where it waives their premium. Disability continuation of plan premium, which is a great rider, and also the dependent child's rider. So these are all some of the riders that are available on the IUL Express. Now what I want to do, well, let me stay on this screen. I put together a sheet here. This is where you may want to take some notes. So I put together a kind of my own personal list of pros and cons for each product, okay? So I'm going to kind of read from my notes. First, we're going to go over the Term Life Express, some of the things that I like about the product. One is that you have guaranteed premiums that are locked in for 30 years. So you know that the premiums are never going to go up. The other benefit of the ROP is you have guaranteed cash value. That you know at the end of 30 years exactly what the policy is going to be worth. You have the living benefits. Also, the term life is available to be available coverage until age 100, which is good. You can also, at the end of the term, you can convert it to a reduced paid up policy, which I'm going to show you here in a minute. It has a very simple, easy application process because with return of premium, there's no illustration required. Now, the cons are is that it's only available in the 30-year product. So in order for the client, if you're selling someone at age 45, in order for them to get their money back 100%, they have to wait until they're 75 years old. So let's say they retire at 65, they can get the money, but it's going to be at a reduced amount. They got to wait the whole 30 years. That part, not crazy about. There's no upside for higher cash accumulation. So what you get is what you get. There's no potential of a credit strategy that could potentially get you more. It's only available on a 30-year term. The max issue age is 50. I wish it was higher. There's a few other carriers that have ROP that are available all the way to age 60, I want to say, like American Amicable and Americo. And the other thing is that there's no disability income rider available. I wish that rider was available in combination with the return of premium. So those are my pros and cons. For the IULE, the pros are it's permanent life insurance designed to last forever. So you don't have to worry about converting or, it's designed to last a lifetime. There's flexible premiums. So if you start the policy out at $150 a month, or maybe you're overfunding it a little bit, and then you decide, I really can't afford that right now, you can bring the premium down to the minimum premium, and then you can pick it back up. They have a catch-up provision which allows you to do dump-ins later that can go into the cash accumulation. The other thing too is that you can because the premiums are flexible with the IULE, we can design it so if the client only wants to make 15 or 20 years worth of premiums, we can design it so they only have to make a certain amount of premium payments, and virtually the policy will be paid up because the cash value accumulation will continue to make those premium payments for a lifetime. Can't do that with a term product. Strong cash accumulation potential, tax-free distribution through either withdrawals or tax-free loans against the policy. It has living benefits, issue ages 18 to 70, which is great. Some of the cons, not a lot of negatives on this policy. I do wish that for age 50 and below, I wish the face amounts were a little bit higher, maybe up to 500,000. I think that would be better. I'm not a big fan that you have to get a signed illustration, even when it's like easy solve, when they're not putting in extra money. I wish that requirement could go away, but it probably won't. There's not a term rider available. In an ideal world, I wish the IUL Express, you could do an IUL and then you could do like a 10-year term add-on. That would be a great enhancement. I'm really pushing Mutual to add that. And then there's no disability income rider on the product. So those are really the only negatives that I have on that product. Michael, how are we doing so far, sir? Is this good information?
It is, sir. I'll tell you, this is something that agents ask a lot about, and sometimes we put the blinders on. We think we can only write final expense, but at the end of the day, our commitment is to always do what's right by our client. And these are two wonderful more arrows that we can add to our quiver, 2 more bullets in our gun as we're out there and meeting people. And let's face it, we're not just focused on the client we're talking to today. They have relatives, they have friends that may qualify for way better and final expense. One of these products would definitely help them out.
And I know I have a habit of being a little bit of nitpicky and getting into the weeds a little bit, but at the end of the day, I love both these products and they're both super strong, and you're doing your clients right if you sell either one of them. I just have a habit of sometimes getting a little bit, nitpicky on things. All right, let's focus back to the Term Life Express with return of premium. What you see here is an illustration. If you ever want to show, do an actual illustration, if you use the WinFlex, you can actually print an illustration for return of premium. You don't need to. Most of the time, I just write it out on a piece of paper for them to understand it, but you can't actually print this if you want to. So this shows you what we have here, Michael. We have a male client, age 46, and we're going to do $150,000 of term. This is with the ROP. The plan premium is $190 a month. This shows you what the base premium is $1,200 on an annual basis, and then the return of premium is $882 a year. That's what it's costing them extra each year to be able to get their money back. So this shows you the initial monthly, the base costs. So in other words, in order to get the ROP, the client is putting aside an extra $78 a month, Or this is a way to look at it. Over a 30-year period, they're funding their policy an extra 28,000, but in order to get back 68,000. Now, to me, that's kind of a no-brainer, right? Like Mr. and Mrs. Client, you're good, especially if they're going to buy the term anyway. Yes, we're going to get it. Well, let me show you this way where over the next 30 years, all you need to do is monthly set aside you just need to set aside 28,000 to get back 68,000. I mean, that's more than twice their investment. In fact, it shows you here is that the client, in order to get the same performance, and I love this, they would need to deposit every month into an account $78 a month at an annual rate of return of 5.35 in order to get that accumulation. Okay.
Wow.
The difference is, Michael, the selling point is that if you put that money into an investment account, okay, and it grew, you would be subject to capital gains tax.
Correct.
Here, there's no tax. It's not subject, it's tax-free. And the reason why is because technically it's not in an investment. You're just getting a refund. There's no, if you go to Walmart and you buy something for $1,000 and 2 weeks later you return it and you get your $1,000 back, there's no taxes, right?
Right.
It's just a refund. Same thing here. It's just simply a refund. And because it is simply just a refund of your premiums, there's no taxes. Okay.
Wow.
That's what makes the ROP such a huge selling factor, is the fact that it is tax-free without having to worry about any capital gains tax. Now, so at the end of the 30 years, your clients have a simple decision. Do they take the 68,000, okay, in cash, 100% tax-free, by the way? Now, the caveat is they have no more life insurance. But in this case, at age 76, do they really need life insurance? They're kind of self-funded. They have $68,000. They could go to the funeral home and do a prepaid funeral, or maybe they take 10,000 of that and they purchase a single premium whole life for 15,000, and their final expenses are paid. Plus, they have $53,000 left over, tax-free. The other option is that if they really want life insurance, they could allow Mutual of Omaha to keep the 68,000, and they would get a reduced paid up policy of 103,000. Okay, that they don't have to make any premium payments on. Not a whole life policy. It's a reduced paid up term policy, good until age 100. Okay, now that's the bad news. It's only good until age 100. So if you have that client that makes it to 101, I guess technically they don't have any more insurance, so they better hope they die before 100. The most popular option is what I sell on, is keep the money. Take the money tax-free, and if you want a little life insurance, we'll help them get, they can do like a single premium whole life where they don't have to make any premium payments. Okay, that's the best way to go, and to keep the money. So that's the ROP. Super, and you explain it just the way I just explained it to you. Okay, and it's kind of a no-brainer. I love the ROP. Okay, are we ready to move on, Michael?
You're ready, my friend.
Okay, now what the first comparison I'm going to do is I'm going to compare side by side. That was the ROP. Same client, Mr. Johnny Cash, age 46, non-tobacco. We're going to do 150,000 of life insurance. And I did this as, when you do the illustration, I did target premium. Okay, target premium is the premium that's designed to keep that policy, you could say, on target for the rest of their life. They don't have to worry about it lapsing. When I did target premium on WinFlex, I came up with a premium payment of $155 a month. So already right off the gate, this is $35 a month cheaper than doing ROP. The benefit of the IUL Express is that if they can't afford the 150 a couple of months, or the 155, I should say, they can do the minimum premium and then they can catch up later, or they can increase that and put more money into it. When you do the allocation, which is the interest credit calculation, there's a couple to choose from, but we're only doing one, and that's the S&P 500 100% allocation. And when you either do WinFlex or you do it from your phone, it's the automatic default, so you don't have to worry about changing anything. The allocation, the current illustration rate is at 5.87%. Now, this look back, this is like a 25 to 30 year look back at what the S&P 500 has performed at. This is not some random number that Mutual of Omaha came up with. And the other thing that you need to know and that the client needs to understand is, Mr. and Mrs. Client, your premiums from this policy are not going into the stock market or the S&P 500. We simply use the S&P 500 as a credit strategy to determine how much interest you're going to get. So your money's not technically in the stock market. But if the S&P 500 goes up 7% next year, you're going to get 7% interest credit. The great thing, the other selling point about this product is that it has a zero income or zero interest floor. So what they need to understand is that if the market crashes from annual point to point, the market's down 10%, they don't lose any money, Michael. They have principal protection guaranteed that they will never lose a penny in this product. It only has upside potential, no downside. So that's kind of a huge selling point. I just noticed here, this also, when you run the illustration, which by the way, if you sell that, you're going to need to run the full illustration. I'm only showing you a couple of pages. It lists all the benefits that they get, the critical, chronic, and terminal illness. Okay, enough about that. This is what they call the tubular report. This is what you want to focus on when you're selling the IUL to your client. So we got Johnny Cash, age 46, $150,000 death benefit, $155 a month, which is $1,865 in annual premium at target premium. This shows you the guarantee, which is assuming that the stock market stays zero for the next 25 years. This is the midpoint, but this is the point. This is the column to the far right, which is the non-guaranteed illustration rate. This is the column that we need to focus on, because this is where the S&P 500 has actually performed for the last 25 years. The other two columns are just legality. We're just required to show them that, like, worst case scenario, okay? So as you can see here on the non-guarantee, there's three different columns. There's the accumulation value, there's the surrender value, and then there's the death benefit. We're only dealing with level death benefit, which means this is if they die, this is the amount that the beneficiary is going to receive. The cash accumulation or surrender charges, this is if the client decides, you know what, I want to surrender my policy. Well, as you can see, let's see here, they are equal here. There is a 15-year surrender schedule on this policy. So if they want to cancel the policy, there are surrender charges for the first 15 years. After 15 years, you can see that the accumulation value and the surrender value are exactly the same. Okay? So what I want to show you is after just 20 years of them making premium payments, they already have $38,000 in accumulation value, which then they can borrow against from their policy, and they can start receiving money, or if they need money, they can take that. The great thing about this policy is they don't lose their $150,000 of life insurance. Whereas with a term product, there is no option to borrow from the policy. You could cash it out, take the money, but now you have no life insurance, right? This, they have both. Now, watch. Because we're comparing a 30-year term. I kind of messed up on this. I meant to do it for 30 years, but I only did scheduled premium payments for 29 years. That was my bad. But nevertheless, in this illustration, what I'm showing is on the IUL is that the plan premiums of $155 are only for 29 years. So at the end of 29 years, they're not going to make any more premium payments. Okay? So they're at age 76, I'm going to show it 30 years. Michael, they paid into the policy in premiums $54,097. Got it?
$54,000, okay.
Okay, look at the cash accumulation. $74,768. That's $20,000 more that they put into the policy. So they got $74,000 of accumulation value that they then can start taking lifetime income withdrawals from. But guess what, Michael? They still have $150,000 of life insurance.
That is huge.
So it's not you're trading one for the other, it's both. So So here's my notes, just as a comparison, okay? With the IUL, illustration number 1, premium payments for 130, okay, just in premium payments, if you take the fact that they were, remember, this is $35 cheaper than the ROP, okay? So if you take $35 a month over 30 years, in this illustration, the client saved $14,306 just in premiums.
Wow.
Okay. If you look at the cash value on the ROP, they're going to get back $68,000. In this illustration, they're going to get back $74,000, which is $6,366 more. Dude, that's a $20,000 spread.
Yes.
$20,000 difference between those two. Plus, they still have life insurance. With the ROP,
both ends.
At the ROP, yeah, it's a great product. They take the cash, but they have no life insurance. This, they get both. That's why I love this product. Okay, now I'm going to show you one more illustration. Okay. Illustration number 2. Let's say your client, when you show them the ROP, the $190 a month, it doesn't faze them. Oh yeah, I can do that. I'm going to show you a way that they can overfund the IUL. You keep the face amount the same, but they put in the $190. This time, we're only going to make 20 years of premium payments. Okay. So here we got Johnny Cash. We're at same 150,000. So we're keeping the face amount level. But now, because the client can afford $190, no sweat, I can do that. Same credit strategy. Okay. Now we're putting in $2,280 a year. And again, same thing applies. You got accumulation value, surrender value, death benefit. Okay. After 20 years, the client put in $45,600 of their own money. Already, Michael, just in 20 years, they've already accumulated $53,481 in money. So they're already ahead of the game by $8,000. Okay.
Wow.
Now, the way I have this scheduled, I'm going to flip to the next one. Remember, I got this set up. So after 20 years, look, guys, no more out-of-pocket cost. okay? But the client is not going to start taking withdrawals. They're going to sit on it. Just look what happens, Michael. Let's say they make 20 years worth of payments. They
Okay.
never put in another penny, and they just let the cash accumulation, that 53,000, they just let it grow for another 10 years. Because remember, we're comparing a 30-year term to, so I wanted to kind of do apples to apples, so to speak, okay? At the end of 30 years, even though your client only put in 45,600 in premiums, the accumulation value has the potential of being $81,686.
Wow.
And they went 10.
Wow.
Now, just think if they kept overfunding it. Just think if they put in 30 years of 190, that would be well over 100,000. Okay.
What a
Now
phenomenal investment vehicle.
it's the best of both. It's an investment and you get the death benefit. It's the best of both worlds. So illustration number 2 is that they did the same premium payment, the 190, but they only put in 20 years of premium payments. Okay. So they
Okay.
saved 10 years of premium payments, 10 years of $190 a month, Michael. That means they saved $22,803 in premiums over a
Wow.
30-year period. Okay. And then you look at the cash value. The cash value is 81,000 versus 68,000. So that's $12,500 more in cash. Now you're talking about a $35,000 swing.
Goodness.
So, man, what an awesome product. Just keep in mind, if your client can get approved for Term Life Express, they can be approved for Term Life, or I'm sorry, IUL Express. It's the exact same underwriting. So both of them are awesome products, but you can see why I'm leaning way towards more the IUL Express because it has so much upside potential. Again, and not that it's a
Agreed.
negative, but the only drawback is that you got to make sure that you can do a go back. You got to get that illustration signed. So critical that you get that signed, get it signed up front, and then you fax it or you email it over to Mutual of Omaha. So when they process your application, they approve your client, they already have the signed illustration. Then it's done quick. You get paid fast. Your client gets their coverage in force quicker. But Michael, how do you like them apples, buddy?
That is phenomenal. If that doesn't get your client's attention, I don't know what will.
So hopefully, okay. So we did pretty good on time too. We're under an hour. So guys, hopefully this information has been helpful. If you go to the Senior Solutions website and you want to get more information about IULs, go to the Senior Solutions website, click on Agent Resources, click on Sales Training, and then go down to the tab that says IUL Training. And I've got more videos on. There's even one video. Well, maybe I think it's in there. We have one video that's like a consumer video. It's like a 12-minute long video that you can kind of send to your clients to kind of have them take a look at it. But we've got some great additional training. So hopefully this has been an eye-opening experience of kind of the comparison between ROP and IULE. So if you need some help, running illustrations on WinFlex, contact me. I can help you walk through it. So that's it, Michael. Let me give you the honors to get signed off today.
As we always say at Senior Solutions, we want you to be an insurance professional and not a policy peddler. Now, there's thousands of policy peddlers. When you know these type of products and you always do what's right by your client, you're going to be seen as an insurance professional. And insurance professionals are really the ones that enjoy the time and financial freedom we're all looking for.
Yeah.
So definitely go back. We went over a lot of good stuff today, ladies and gentlemen, over your holiday weekend. If you get a chance, pull this back up. Joe will be posting on YouTube. Take that legal pad out, and you're going to have additional questions, and that's what me and Joe are here about. Reach back out to us again. It's sometimes it takes some people longer than others to digest this. But right here, you'll be solidifying your position as an insurance professional when you can present products like this. So with that, as always, everybody, even though you're in business by yourself, you're never, even though you're in business for yourself, you're never by yourself. Senior Solutions is with you every step of the way. We wish everybody a happy and restful Easter weekend. Focus on your family because that's what's most important. And Joe, I hope you and your family have a happy Easter as well. Thanks, Senior Solutions Nation. Have a
All right,
great
everybody.
weekend.
All right, man. Take care. Thanks, Michael.
You too.